everyone, and welcome to this episode of the Fat Pitch Podcast. I'm your host, Paul Borowski, Chief Distribution Officer for Sealy Investment Securities. And as always, I'm joined by my co-host, Clint Sorensen from Wealth Shield. Clint, how we doing today?
Doing great, Paul. Great to be back. It's been too long.
It's been a hiatus. I can tell by your enthusiasm, you really missed me. And unfortunately, that hiatus was my fault. And we're joined by a dear friend today. And in full confession, we're actually with him up in Park City, Utah right now. You've been a gracious host. Chris Nero, thanks for joining us on our podcast today.
Happy to be here, and thanks for having me.
You betcha. Well, we won't darken his door for too much longer, Clint, but you've known Chris for a long time. You introduced the two of us. Chris, what can you tell our audience about yourself? What's your origin story? Why don't we go there?
Yeah, thank you. So, I'm about 34 years in the business, right? Can't you tell? I'm using a filter, but I don't think it's working that well. But 34 years in the business. Really started on the public side of the business. Early days, I always have to be careful about, I tell people I started with the SEC or I was with the SEC, so they may interpret that differently. But so first 4 or 5 years of my career was with the SEC, left there, went to work for a couple asset managers, Scudder, Stevenson Clark, which later became part of Deutsche Bank, ironically. And then left there, went to work for an asset management holding company, and so learned a ton about asset manager valuation, product distribution. I went to work with a group of guys that left Putnam Investments, a guy by the name of Norton Reamer, who ran the Voyager Fund. So really listed company, owned 55 institutional asset managers. So great experience there. And then I think got tired of the cold in Boston, so an opportunity came up. Late 90s to move to the West Coast and work for a hedge fund. It didn't sound like a bad deal. Moved to San Diego and, did that for a while. And so really interesting, I think one of the things I learned was, coming from a structured and public markets background and moving into hedge funds, such a big difference just in terms of structure, regulation. And at that time, you may recall, late 90s, was when a lot of pensions and endowments were just starting to get comfortable, right, in private markets. It's really more hedge funds and private equity at that time. But frankly, from my position and my background, really saw the major differences and really tried to help those groups and accommodate them as they moved from public to private markets. And so I guess I sort of found myself in that gap between public and private markets at that time, right, which is where we are today and we'll talk about. But so I was there a couple of years, started working with some endowments who really wanted much more visibility into private markets. And so I started doing that at our hedge fund for them, and then saw this opportunity. If I'm doing this for them with our fund, I can do this for them across a lot of funds. So I left there. I started a company called HedgeWorks. In 2000, I ran that business for about 8 years. We grew that business globally, and then I sold that business to Deutsche Bank in 2008. And, my timing was not planned, but it was impeccable. This was January of 2008. I sold, and, I always tell people maybe a year later, the person that sponsored the deal, Deutsche Bank, patted me on the knee and he said, you picked a really good time to sell us your business. It was sort of an uncomfortable spot, right? But this was when, I think between 2008 and 2009, you had the Madoff crisis, Bear went under, Lehman went under, we had credit crisis going on. So everything that could be thrown at us was thrown at us. So it was a really interesting time, but we learned a lot. We were still able to grow the business about 300%. We really moved from, doing analytics and third-party pricing to custody lending against hedge funds. And so we're really able to grow that business and move things along despite the market conditions we're in. So anyway, Paul, this is the long version, I guess.
We like the long version. We like this.
You like the long version? So 2011, I left. Having traveled globally for a number of years, I really had to go back home and spend some time with my family. I had 3 young kids and a great wife. So did that for about 7 years, did a lot of board work. I was on the board of a few Franklin Templeton funds. I was on the board of an ETF company. And my wife and I and a few other families helped to start a private school in San Diego. So I was on that board for 12 years. So That was, 7 years of sort of gearing down and sitting on the sidelines a bit. And then, 2018, again, found ourselves in the middle of this, what I would call public to private market transition, and saw an opportunity there. And that's when we started Bridgeport. So, we can talk more about what we're doing there, but that's it. Yeah.
Let's talk about that. Clint, you and I really got to be friends with a shared passion for the private marketplace. And we both loathe, and Chris, you've talked to us before, I think we all loathe the term alternative. What's remarkable about you building Bridgeport is, I think, and correct me if I'm wrong, doesn't it all start for you on education?
I think if we look at where we are today, right, and I think we all saw this coming with the platforms that started emerging, as if you take a step back and look at any fiduciary, but specifically advisors, right? I think that advisors started, really transitioning toward private markets sometime between 2000 and 2010, right? But as they've done that, education is a big part of bridging that gap, right? And I think part of that, there's really two parts to that. One is, Paul, if I'm going to ask you as my client to invest in a private credit fund, I need to know what private credit is, right, before I can explain it to you. So that's one part of the education piece. The second part is really helping the client to understand, what private markets is all about, what types of private market investments is suitable for them. So education has always been a part of it. And I think as we continue to see, advisors and clients and all fiduciaries really move from public to private markets, education, among a number of other things, are really going to be an important part of bridging that gap.
Do either of you have a feeling for how much of a movement has been made of accredited high net worth, ultra high net worth investors from public to private? Do either of you have any data on how far we've come since that move started?
There is a good amount of data. There's two white papers in particular that come out in the last year. McKinsey put one out early in 2023. Bain Capital just put one out in July of 23. And the numbers move around, but I think if you look at what they'll refer to as the accredited retail market, you'll see data that market is massive. It sits somewhere between 45 and $70 trillion of, accredited high net worth investors that are sort of sitting on the sidelines. And so the data looks like that typically those investors sit between 1% and 3%. Many are at zero, frankly. And so, what those white papers talk about is, that is the next boom in private markets, right? If you look at endowments sort of sit in that 60 to 80% place. And so even if you move that needle from 1 to 5%, it's massive, right? And so I think particularly in the case of McKinsey, I think they refer to it as the next growth frontier for GPs, right? That's really the direction they want to be moving in. And I think that there's a lot that has to come with that. In particular, Bain talks specifically about infrastructure, right? There's a ton of infrastructure needed on the private market side. And that's really what we're doing.
Yeah, and that's really what Bridgeport is at the core of your mission. Well, I would ask both of you with your history, and Clint, you may have some real thoughts around this. I remember being an equity guy in New York City in the late 90s, and we talked about the fund business. It's when I heard you mention Putnam Voyager, I was thinking, golly, you're bringing back olden times for me. But when I would see these alternative products, the early versions or private products for retail investors, there was an adage like, hey, this is the gum stuck on the end of the institutional guy's shoe that they're passing on. Do you both believe there's been an improvement in the structure and what's available for the retail investor? Clint, I'll ask you because you work with so many folks like that.
Yeah, access has really opened up, right? So if you think about it, back in the early days, it was kind of like that. You had really this bifurcation. You had, the type of products that were available for retail, which may have been the gum on the end of the institutional shoe. And then you had the type that was really available for institutions. And I think that gap is closing. And I think you're seeing a tremendous amount of product availability for retail investors now that are, on par with the institutional type product. There may be some differences, but they're pretty much on par. And I'd also comment on Chris's earlier mention about the two white papers. I remember seeing a study from UBS, their family office survey. It was pretty crazy because I like the idea of this accredited investors being the next one to move, being the big wave coming. But when you think about family offices and the QPs, so the qualified purchaser types, they've been allocating to private markets. And I remember, I think it was a 2021 family office survey I saw from UBS, but they asked what percentage of your accounts are in mutual funds. And that percentage was 0. When they asked what percentage was in ETFs, it was like less than 1%. And these were all families with 25 million or more. And so they were already allocating to private markets in a big way. And then in their public market strategies, they were more like in individual securities. So I think people are waking up to building diversification into a portfolio. And I think that's pretty awesome. And hopefully, Chris, your product, right? The infrastructure will help them do that even better.
Absolutely.
Yeah, Chris, Bridgeport is your latest venture. You just can't stay retired, huh? That's the thing of it. Only so much tennis and boating a guy can do in a year. Yeah. Can you describe what Bridgeport is at its core?
I think if you look today, I mean, we've spoken a lot over the last year or two. If you look at the traditional 60-40 model, that really sort of blew up in the last 2 years. And so, I think the question remains, where do we land? Is it 50% equities, 25 fixed income, 25% private markets? I think we all have a view on where that's going to go, but we know the needle's going to move. And so if you look at that gap as an investor who's used to, traditional markets or a traditional public market environment, there's a lot of things that need to change, right? First and foremost is education that we talked about. Advisors need to be educated. Clients need to be educated, number one. The second piece is infrastructure, right? I mean, just take a simple example, Paul. If I'm an investor or an advisor, I can go to Schwab, I can go to Fidelity, I can open a custody account, I can manage my client assets, right? I could go in, I could buy 5 ETFs for my client. It's very simple. I set up a profile, I click buy on 5 ETFs. I go to that account every day. I see my value. I see what I own on an aggregate level in terms of diversification, right? Very simple process. Now I go and I want to buy my client 5 hedge funds. Think about how that works. I've got to go to 5 different sponsors. I've got to fill out a 60, 70-page subscription agreement. Every month, I've got to go to 5 different web portals. I've got to find my capital statement. They come in at all different times. Their valuation frequency is all different. And then I have to go to each of those access points. I've got to get tax reporting. I've got to get statement information. And now take a step back. It's very difficult for me as a client or as an advisor to see what I own, right? What do I own in the aggregate? Number one. Number two, what does my liquidity profile look like, right? Because that's a big dynamic that changes when you move from public to private markets. And so a lot of what we're doing is we're saying, okay, if you take that public market experience, how do we get that on the private side, right? Because that is so critical. Because even, let's say, Paul, you're my client, and I say, okay, I'm going to take 20% of your portfolio. I'm going to move it from public markets to private. You look at your statement and you see, okay, my advisor made a $500,000 investment in this hedge fund. Where's my money? Because it's not on your Schwab statement anymore. It was wired directly to the sponsor. It's probably not held in a custody account. So, now there's complexities around reporting. Now there's complexities around how I deal with you as my client. Those are critical things in terms of how the infrastructure needs to evolve, really for us to go from this, call it 0% to even 5% or even 0% to 2%. And so in the public markets, we have DTC, we have central repository for clearing and transactions. We don't have that in the private markets. And so really what we're about is creating an infrastructure that really bridges that or accommodates that transition from public to private markets. And it sounds fancy and it sounds nice. It's not simple. It really takes the whole industry to be on board with that and move it. So, I will say this today, we're really seeing that movement happening. We're still in the early stages of it happening, but we are seeing it versus 5 years ago. You look at all of the constituents in the marketplace, you look at custodians, administrators, sponsors, really wasn't happening. And so I think the good news is it is starting to evolve now.
So you're really taking the friction out of the process, or attempting to take the friction out of the process for everyone that's involved within private markets investing, whether it's the stakeholder, the advisor, the actual end client, whether it's, other stakeholders like administrators or legal teams or auditors. You're really providing that digital infrastructure to create, and I'm going to borrow your term because you haven't said it yet, but that single source of truth for each
Absolutely.
private market product. And so could you elaborate a little bit more on this whole concept of digitization and single source of truth and what that could mean for the industry long term?
Yeah, I mean, there's a couple pieces to that. I think, first and foremost, you got to take a step back and you have to understand the life cycle of investing in any kind of private market investment, right? And for us, when we talk about private markets, it's hedge funds, it's private equity, it's venture capital, it's direct privates or co-investments, right? Those are all part of the private markets. They're all securities issues under Regulation D typically. So there's no infrastructure requirements, right? But as an advisor or a client, think about the life cycle, right? The first piece of the life cycle is access. I need access to private market investments. Where do I find them? I can't just go online, right? They have general solicitation exceptions. Typically, I can't just go, look for them. So access is first and foremost. The next piece is really diligence. There's not a lot of public information available. So typically you have to go to a third party. You want them to examine that, and you need to find somebody that really understands that strategy, right? For a typical wealth advisor, they can't just go and look at a private credit fund, right? They might be able to look at the data. They can look at the performance, but they really don't understand the ins and outs of that business. And so, diligence is the next step. So you get access, you get diligence. And then simple things, you have an onboarding process. If I'm an advisor and I want to put you and Clint in a fund, how do I do that? I can't FedEx you a 60-page subscription agreement anymore. It doesn't work, right? And so I really need to digitize you as an investor and create a digital profile. And really, if you look, we go back to the Schwab or Fidelity example, they've been doing that forever. You go onto a website, you set up your profile, you set up your qualifications, you set up your experience, you set up your risk tolerance, right? Once that's done, now you move into onboarding. You actually procure those transactions, right? And now as you sort of go through this life cycle, the next piece is reporting, right? How do you now report and aggregate all that data that you're pushing out to potentially 10, 20, 30 sponsors? That's the next piece. And then the final piece is really integration, right? With what we do, we want to digitize. We want to make the investor experience better, but there's a number of challenges that come along with that. One is when you go to these advisors, we always talk about disruptive technology. The way we look at this technology, it needs to be additive, not really disruptive. We're disrupting a marketplace. We're disrupting private markets in terms of, providing access, but advisors don't like disruption. Clients don't like disruption. So we really focus on being additive, right? So when we go to an advisor, we say, look, we want to help you incorporate private markets, but we don't want you to rewire your whole system. We really want to be additive. So how do we take what you're doing today, allow you to incorporate private market investments into that, but make the process simple and additive where you don't have to rewire everything? And so I think really understanding that full life cycle is so critical. And, the challenge we have today still, I think, and, the runway's gotten a lot shorter, but it is a long educational runway. I think that we are going to see probably over the next decade a huge transition to private markets, but it's a process. It's a long educational runway, but it is happening and it needs to happen. And I think that's why so many of these, sort of white shoe consultants have come out and written all these white papers, because everybody sees it coming. Nobody knows exactly how to do it, but it has to start, and that's really what we're doing.
Yeah, and I think there's probably, speaking of white papers, one that's been circulating around Midtown Manhattan starting about 3 years ago, because the biggest private equity shops and the biggest international bankers didn't want to provide offerings or product for just the accredited masses. And now it seems that they're all coming out with them looking to capture those dollars. But I agree with you. It's got to be seamless. And the other part is the ongoing monitoring of those investment positions. It's one thing to learn about it, to get the knowledge to set it up. It's another thing. This isn't a mutual fund that you can sell next week or even next year. Often somebody's involved with something for 4, 5, 6, maybe even a decade, a long period of time. And so managing and monitoring that along with your other positions for both the advisor and the investor is critical. So I imagine that's a key piece if this business is going to continue to expand and grow and provide opportunities for investors across the gamut.
Absolutely, and that is the biggest piece. I think people confuse digitization sometimes. They think that's just simply taking a process that's been paper-based and moving into digital form, and that is a part of that process. But I think you have to look a level deeper, and these are sort of the essential components. When you look, like if you look today and you own 3 hedge funds, okay, and you want to understand, okay, what's my liquidity? When can I get out of that hedge fund? What does my lockup look like? You know, when those are paper based, that is very difficult to do. And again, take that to an advisor level. If they have 200 clients in 40 different private market investments, how do they track all those things? They're all paper based. So item one is digitizing that. But when you digitize it, that's when the magic happens, because now everything is data based or data centralized. And so perfect example, if you take the term sheet of a typical hedge fund, which normally you would have to go and thumb through about 100 pages to find those terms, you take a digital term sheet, you have everything from management fees to lockup to redemption frequency. As soon as you have those all in a database, and now you have that, say, across 10 different funds, now those all can be centralized. Now you can create algorithms to run off that data. So, for example, if I owned 10 paper-based hedge funds, I have no idea what my liquidity looks like. If those have all been digitized, I can look at my portfolio now. Our platform can track and say, okay, you invested in this fund on this date. This particular fund has a 1-year lockup. You've been in for 255 days. You have a quarterly notice period. It will tell you exactly when you can liquidate or redeem from that fund. And now it takes that and it stretches it across 10 funds, 20 funds, 30 funds, and you have a full picture of what you own, and you have a full picture of what your liquidity looks like across your portfolio. Yeah. And that is absolutely critical, because as these advisors move into private markets, liquidity is a huge part of that, right? And we know that private markets, you look at real estate, you look at private credit, you look at venture, you look at hedge funds, they're all over the place in terms of holding periods. They can be a year, 2 years, 5 years, 7 years, 10 years, right? It's not a 60-40 portfolio where you can be out and, inside of 2 or 3 business days. So those digital elements are absolutely critical, and that's a lot of what we're doing. And those are essential for this transition. And that's the infrastructure I think that we focus on. And again, that's where all of these components can be hugely additive to advisors and their clients, really for giving them that visibility.
That's very cool. I have a question for both of you, because you really seem to have your fingers on the pulse of it. Are there any trends, overall trends, maybe in types of structures that you're seeing more of for individuals? Or are there particular asset classes right now that you're kind of hitting your purview more than not? Usually Clint would tell me if it's really popular, that's probably when it's the most expensive. But either of you, just any kind of trends in the private market besides, what we've talked about?
I'll let you shoot first, Chris.
Yeah, I was going to say, I'll let Clint talk more about the strategies. I mean, I think we all know right now, right? If you look across private markets, private credit's probably the hottest thing at the moment.
Follow the ball,
I think.
Sure.
Yeah, for sure. But I think just in terms of getting access to those strategies, I think the big thing that we're seeing is what we call feeder structures, right? Another challenge, we talk about some of the challenges as investors transition to private markets. Liquidity is an issue, but access is challenging. We're working with a fund right now. They have a $25 million investor minimum. So as an advisor, I have 2 issues. One is probably 75% of my clients or more do not have $25 million in liquidity that they can put in this particular fund. Number one. Number two, even if they did, I can't put 100% of their assets in that fund. And so when we create feeder structures, really what we're doing, we call it, advisor syndication. It's going to allow that advisor to go across their client base and say, okay, I don't have one client that could do 25 million, but if I go across 50, 60, 70, 100 of my clients through a feeder structure, I can aggregate them. We can create an SPV and we can go in as one investor. And so now my clients get access to a fund that's often very difficult to get into, and they can get in at $500,000. And so when I create their portfolio, let's say they have 5 million in liquidity. Now that particular investment is 10% of their assets, not 100 or, not accessible at all. So those feeder structures are really, really important. And they're an important part of this bridge I talk about from going from 60-40 to private markets. So definitely the feeder structures are hugely, yeah.
That's great information.
Yeah, I mean, I just love that for wealth managers. If you think about it like an RIA, right? The ability to have a series of feeders that can aggregate not only your best ideas and best thinking in a particular asset class. Like if I'm a firm, I might have firm feeder for private equity, for private credit, for long short hedge funds, for managed futures or CTAs, for private real estate. And I think that's really a great example of being able to create a process that is reducing the friction for the end client. Because now I can bundle clients together, put them in my best thinking in a strategy, put that strategy together in a way that simplifies, right? Bundle the tax reporting, everything, all the reporting features, and give them an experience that's a lot better than them having to chase down a bunch of different products and have to meet minimums. And so I love that for wealth managers, Chris, to that point, is them being able to create feeders. And I know you guys can do that, right? You can help an RIA create a feeder, right? Leveraging your infrastructure, leveraging your platform, and they can create these type of things for their firms or for their clients rather at the firm level. And I think that's a growing trend, Paul, and I think that's going to be a big push going forward.
Well, the nice part is you can filter to which you think are best ideas. And then you can aggregate dollars that have more buying power to, in an ideal world, perhaps strike a better institutional pricing on an offering. So in an ideal world, and then like you said, I mean, I don't know about you. I think my last K1 this year came in on October 13th. And so it's the annual I hate you, no, I hate you more with my prepare. Right? So that also simplifies that to some degree. And then, Chris, you mentioned something. I mean, there are single purchase funds. There's called capital structures. There's drawdown. I would imagine Bridgeport or things like it. You're also really keeping an eye not just on liquidity, but capital commitments, which I don't care how much money somebody has. Yeah. Sometimes having to write checks or sweep money surprises all of us. So that's critical too, to manage your balances right now.
It absolutely is. Yeah. And I was going to say, again, that falls into advisor and client education. I think it's great when you can go to a client and say, look, we can get you access to this great venture capital fund and, we'll put $500,000 or $1 million into this. But, for most clients and frankly, for many advisors, they just don't understand how that works with a venture capital structure or private equity structure, what we call a committed structure. You may commit $1 million, but there's a process, You commit that money, but over the course of a few years, you're going to get these capital calls. And so I commit $1 million. I can, 3 months later, the advisor comes back to me and says, I need $150,000 in 2 weeks. Okay. So, that is a process advisors need to be mindful of. You need to make sure that client has the liquidity to accommodate that. You need to make sure the client understands that, and again, managing the logistics around all of those things is tough. And so, again, I go back to what we call the life cycle, right? Understanding the entire life cycle of private markets and private market investments and how it works is critical. And, from our standpoint as a technology provider, you really have to provide technology from the front to the back, because if you just provide one piece of that life cycle, you go back to the same issue. You're not being additive to the advisor. You're giving them one tool when they need 6. And so, filling that entire life cycle is absolutely critical to really helping them make that transition. Because again, as an advisor, I want to do things that I believe are additive to my client. I don't want them to disrupt my relationship with that client. I don't want them to disrupt the process I typically have with that client. And I certainly don't want to bother my client with these things, right? I want to bring something new to them, and I don't want to create more work for them. And so, there's so many components to this technology and this transition from public to private markets. And I think, we're really focused on that, is, really giving people a front to back additive experience. And it sounds nice, but it is a challenge. There's a lot of components to it, but, it's happening.
Well, Clint, you got a final comment or question for our good friend Chris here? Will we wrap up this episode?
No, Chris, it's called the Fat Pitch Podcast. So would you agree that the fat pitch is the transition from public to private markets? Would be my last and final question for you.
Absolutely. Yeah. I mean, there's no question about it. I mean, and again, you look at just the environment we're in. There's a number of things that we've looked at and we've talked about, Clint. You just look at public markets, right? For example, 10 years ago, you had somewhere in the neighborhood of, over 8,000 public companies, right? I mean, you look at that today, it's down to what, 2,000 or 3,000, right? And so, a lot of what's happening now, what used to be post-IPO growth is now pre-IPO growth. And so you look at companies like SpaceX, right? I mean, still a private company where all of that, asymmetric growth is happening is really in the private markets now. And so as an advisor, I take a step back and say, okay, how am I going to get my client access to that growth, which is much harder to attain now in public markets? Paul, we spoke earlier about this. We used to refer to private market investment as alternative investments, right? And I think that's the key. That has changed. They're essential. And I think if you go back, we can find white papers from Franklin Templeton, Apollo, JP Morgan. There's so many white papers that have come out, right? And it's really about this shift from alternatives to essential. And I think that's a big part of it. And so, that's really why we're so focused on the technology to support that.
I think I'm going to steal your line as a tagline, from alternative to essential. You just came up with some gold there for a guy who thinks about marketing and distribution.
I think I've read it 12 times. So don't quote me on it.
All the credit. That's that Providence Friar education. And you made one other comment before we sign off. You used another term that was simple but elegant, and it was 2 words, and it escapes me. Something about integration, maybe?
Yeah, I mean, there's really 2 pieces to it. When we look at what we do, we are agnostic, and we help advisors augment and integrate. And that's really the way we look at it. If you look at the platforms they have today, our job is really to be able to augment what they have and do it in a seamless way. And I go back to that same word, it has to be additive. And we have to help them integrate, and we have to do that seamlessly. If you look at the average wealth advisor, they don't have a big IT staff. They don't have developers. And so when you go in, you really have to work with them, and you have to do it in a way that is so seamless and purely is just about augmenting what they have to provide a service to their clients. And it's as simple as that. And they don't want to do any heavy lifting, and they frankly don't have the bandwidth or the capacity to do it. And so, we're building an infrastructure. It takes time. It costs a lot of money. They don't have to do that. We work with them. They license that technology from us, and they are up and running inside of 30 days. And so, that's the beauty of technology, in terms of where we are today. It's software as a service. It's a great environment. And so I think, if you look at the transition as it's going on right now from public to private markets, the good news is technology has come such a long way. And so I think that, what advisors will see over the course of the next decade, I believe, is that transition is going to be a lot easier.
Fantastic. So as we wrap up, if people want to find you or find Bridgeport, is there any social media, website? Where can they go and look, whether they're advisors or whether they're good old investors fascinated to learn more about the alternative universe or private universe?
That's right. Yeah, just go to bridgeportft4fintech.com, and there we are. You'll find us.
Fantastic. Well, on behalf of my co-host Clint and our wonderful guest Chris, thanks everybody for tuning in, and we'll see you on the next episode of The Fat Pitch. Take care.
Sounds great. Take care.